Hey everyone, welcome back to the show. I'm so glad you're tuning in today. Today we're looking at How to Day Trade for a Living by Andrew Aziz. This book is essential reading because it completely shifts your perspective. Your only actual job as a trader isn't buying and selling stocks. Your broker does that. Your only job is managing risk. The author, Andrew Aziz, holds a PhD in chemical engineering and went on to found Peak Capital Trading and build a thriving global community of thousands of traders. Now, conventional wisdom says day trading is a get-rich-quick scheme where you just buy low and sell high, but Andrew challenges that head-on. He proves that it's actually a demanding business, where success means learning how to be a really good, disciplined loser. By the end of this summary, you'll walk away with the exact battle-tested rules you need to manage your capital and survive the market's brutal learning curve. Here are 10 lessons from how to day trade for a living that you need to know. Let's talking 5 lessons first.
Yeah, and I think that background, the PhD in chemical engineering, it really informs his entire philosophy.
Oh, absolutely.
Because engineering, it's all about systems, right? It's about controls and mitigating variables.
Right.
So he takes that highly mechanical, process-driven approach and just applies it directly to market psychology.
Which is so different from how most people see the market.
Exactly. I mean, instead of viewing the stock market as this chaotic, emotional casino where you just, roll the dice and hope for the best, he treats it like a complex puzzle.
Yeah.
A puzzle that can actually be systematically solved, but only if you follow strict operational protocols. He basically removes all the romance from trading.
Yeah, no more Wolf of Wall Street vibes.
Right. He replaces it with sheer calculated discipline.
Okay, so let's dive into the specifics. Gikar Kinawan. Day trading is a brutal business, not a lottery ticket. So during the pandemic, millions of people flocked to the stock market, hoping to get rich quickly while stuck at home.
Right, with all that stimulus money, yeah.
Exactly. However, day trading is absolutely not a fast track to wealth. It is an intensely demanding profession that requires the same level of serious study, preparation, and discipline as becoming an engineer or a doctor.
Yeah, it's a real profession.
You have to commit to waking up early, preparing your strategies before the market opens, and sticking to a strict set of rules.
Yep.
Most importantly, you need startup capital to survive the brutal learning curve. If you treat it like a casual hobby, the market will aggressively drain your account.
Aggressively is the right word for it, yeah.
I mean, imagine you decide to open a brand new restaurant.
Okay.
You wouldn't just unlock the doors on day one without a menu, trained chefs, or ingredients, hoping people hand you money.
No, you'd fail instantly.
Right. Day trading is exactly the same. It requires a solid business plan, tools, and capital before you open.
And we actually have the data to back up just how brutal that restaurant comparison really is.
Oh, really?
Yeah. Aziz points to some specific court data from Massachusetts. They actually forced the release of financial broker records. And the numbers were just staggering. After 6 months of day trading, only 16% of day traders were actually profitable.
Wait, 16? That's it?
That's it. Which means 84% were actively losing money or had just completely blown up their accounts. When people hear that, it's a massive wake-up call.
Well, while treating trading as a strict business is a necessary mindset, Aziz might slightly underplay the psychological toll it takes compared to traditional businesses.
How so?
Well, in a regular job, showing up prepared usually guarantees a paycheck, right?
True.
In trading, you can execute your business plan flawlessly and still lose money for the week.
Yeah, that's the hardest part.
Furthermore, the 90% failure rate indicates that structural market forces like algorithmic trading make survival exceptionally rare for retail traders, no matter how professionally they treat their home office setup.
That's a very fair point.
So I have to push back a little on this idea. If the failure rate is 90%, like regular startups, is day trading really a business or just a highly organized form of gambling?
Well, that's the exact dividing line, isn't it? I mean, between the amateur and the professional, gambling relies on luck. It relies on hope.
Right.
When you put your money down on a roulette table, the house ultimately has the mathematical edge. Period.
Always.
But a legitimate day trading business, it relies on executing a proven system where you have the mathematical edge over a large sample size of events.
So you're basically trying to become the house.
Precisely. The reason the failure rate is so incredibly high is that most people approach it as a gambler. They don't do the pre-market research. They don't have a strict risk management protocol.
You just trade on gut feeling.
Exactly. Emotion. The 16% who survive are the ones treating it like a clinical, boring, systematic profession. But to your point about the psychological toll, you are absolutely right. The mental weight of doing everything perfectly and still losing money on a given day, it's crushing.
Yeah, I can imagine.
It requires a level of emotional detachment that most human beings simply aren't wired for.
Which is why the takeaway line here is so crucial. Treat your trading account like a serious startup business, not a weekend trip to Vegas.
Absolutely.
Okay, so that leads us to the next big concept. 2 Paroki 2. Fight like a guerrilla, not an army.
This is a fun one.
Yeah, so the market is dominated by massive institutional traders, hedge funds, and high-frequency trading algorithms that move millions of shares in milliseconds.
Supercomputers, basically.
Right. As a retail trader, you cannot beat them at their own game. Instead, your biggest advantage is your size and agility. Institutions are forced to trade constantly to deploy their massive capital, but you have the luxury of waiting. You can sit on the sidelines, watch for highly predictable patterns, and strike only when the setup is perfect.
Exactly.
Once you hit your daily profit goal, you can quickly exit your position and stop trading for the rest of the day.
It's a hit-and-run tactic.
Yeah, imagine a playground where massive groups of kids are fighting over a single soccer ball.
Okay, I see it.
Instead of running into the mob and getting trampled, you stand safely by the edge of the field, waiting for the ball to accidentally bounce out, grab it, and score.
That's a great visual for what's actually happening out there.
But, this guerrilla tactic is incredibly empowering in theory, but it relies entirely on a trader's patience, a skill most beginners completely lack.
Oh, completely.
The advice breaks down when traders get bored waiting for the perfect setup and start taking suboptimal trades just to feel active.
Yeah.
Also, high-frequency algorithms are increasingly designed to identify and exploit common retail trading patterns, meaning the safe edges of the market are heavily booby-trapped.
They are, yeah.
It requires near-perfect emotional control to actually execute this hit-and-run strategy successfully.
And if we connect this to the bigger picture of high-frequency trading, or HFTs, that guerrilla analogy becomes incredibly vivid.
Yeah, tell me more about that.
So you are quite literally sharing a battlefield with supercomputers that are specifically programmed to shake out retail traders. They look for the exact places amateur traders put their stop losses, and they intentionally drive the price down to trigger them before buying the stock back up.
So they are actively hunting us.
Oh, without a doubt. But Aziz gives a phenomenal historical example to show that these algorithms aren't invincible.
Really?
Yeah. Back in 2008, during the financial crisis, there was an algorithm running called the Buy the New Low program.
Okay.
Its entire purpose was to buy stocks when they hit new temporary lows, forcing short sellers to panic, buy back their shares, and thereby drive the price back up.
Okay, wait, quick pause for anyone listening who maybe only buys stocks normally. What exactly is a short seller?
Ah, great clarification.
Yeah.
So short selling is essentially betting against a stock. You borrow shares from your broker, sell them immediately at the current high price, and hope the price drops.
Okay.
When it drops, you buy the shares back at the cheaper price, return them to the broker, and keep the difference.
Got it. So if the price goes up instead, the short seller starts losing money fast and has to panic buy to cover their position.
Exactly. And this algorithm was designed to intentionally trigger that panic. It worked perfectly until it hit Lehman Brothers.
Oh, man. Because Lehman Brothers wasn't just experiencing a temporary dip, they were actually going bankrupt and collapsing.
Exactly. So the algorithm kept blindly buying the new lows on Lehman Brothers, trying to force the short squeeze.
Right.
But unpredictable human panic had set in. Massive institutional sellers were dumping millions of shares regardless of the price.
Wow.
So the algorithmic bots were completely obliterated because they couldn't account for the unprecedented human variable of a total institutional collapse. They were left holding massive bags of worthless Lehman stock.
That's crazy.
The lesson here is that algorithms only run on past data. They cannot predict absolute human chaos. As a human guerrilla trader, you can see the broader context, identify the algorithm's pattern, and exploit it.
Okay, but let me push back on this a bit. So if these supercomputers are running the show, are we just picking up the crumbs they leave behind? Or can a smart retail trader actually outwit an algorithm? Because sitting on your hands and fighting boredom sounds great, but when you're staring at a screen for hours...
It's agonizing, yeah.
Right. You just want to click a button.
And you've hit on the exact reason most people fail at the guerrilla strategy. Boredom is a day trader's worst enemy.
Yeah.
Aziz emphasizes that your greatest edge as a retail trader is the freedom to simply sit on your hands and do nothing. But human beings hate doing nothing.
We really do.
We conflate activity with productivity. In a normal job, if you sit at your desk doing nothing, you get fired. In day trading, sitting at your desk doing nothing is often the most profitable decision you can make that day.
Because keeping your capital safe is the productivity.
Exactly. You aren't trying to outwit a billion-dollar supercomputer in a head-to-head sprint. You trade where the algorithm is vulnerable or where its massive size makes it clumsy. Yeah, like if a huge hedge fund needs to unload 1 million shares, they can't do that in one click without crashing the stock. They have to slowly bleed it into the market. We, on the other hand, can buy or sell our 1,000 shares instantly.
Oh, I see.
We aren't picking up their crumbs. We're siphoning off a tiny fraction of the massive momentum they create and then disappearing before they even realize we were there.
Man, that's such a cool way to look at it, which makes the takeaway line for this section so true. Your greatest edge as a retail trader is the freedom to simply sit on your hands and do nothing until the perfect moment arrives.
It is a superpower, honestly.
Which transitions us perfectly to how we actually protect that capital when we do enter the market.
Yes, the guardrails.
Right, the guardrails. So you got a month 3, the 2% milk rule for survival.
This is probably the most important math in the book.
Yeah, so the fundamental secret to long-term trading success is simply staying in the game, which means ruthlessly managing your risk. Before you even enter a trade, you must calculate your stop loss and ensure you are never risking more than 2% of your total account balance on a single position.
Never more than 2%.
Furthermore, you should only take trades that offer at least a 2-to-1 reward-to-risk ratio. By strictly capping your losses and aiming for higher rewards, you can actually be wrong in your predictions 40% of the time and still walk away as a profitable trader at the end of the month.
It's beautiful math.
It really is. Think of your trading account like a carton of milk. To keep it from spilling all at once, you apply the 2% milk rule. You only ever pour out 2% of the jug into a glass at any given time. If you drop the glass, the jug remains full.
Exactly.
But, the 2% rule is an incredibly effective guardrail, but it assumes the trader is adequately capitalized.
Right, yeah.
For a beginner starting with only $5,000, 2% is a mere $100 risk.
Which is very tight.
This tight margin might not allow enough breathing room for normal stock fluctuations, leading to premature stop-outs before the stock actually makes its move.
Yep.
This economic limitation often tempts underfunded traders to break the rule and risk 10% or 20% just to make a meaningful daily profit, which inevitably leads to blowing up their entire account.
It's a vicious cycle. And Aziz introduces a concept widely used by professionals to quantify this, defining your risk as R.
Okay.
Yeah, so if your account allows a 2% risk and that equals $100, then $100 is your 1R.
Gotcha.
The entire goal of your trading day is to strictly cut any trade that hits a -1R loss and relentlessly hunt for trades that are a positive 2R or 3R gain.
So you are standardizing your risk, regardless of how many shares you actually buy.
Yes, and the book profiles a former military pilot turned trader, John Hiltz, to illustrate this perfectly.
Oh, I remember this story.
Yeah, when John started out, he set his 1R at a mere $20. He was only risking $20 per trade.
Wow, $20.
Right. For months, even on days he executed his strategy perfectly, he barely made any actual money because broker commissions just ate his profits.
Oh, sure.
But here's the critical part. He survived a string of 28 losing trades, a -28R drawdown.
Ouch.
But because his R was so small, that massive losing streak only cost him around $560.
Oh, wow.
Right. Because he adhered strictly to his R multiple, he survived the brutal learning curve, he built the psychological muscle, and eventually he was able to scale up his R to consistent, massive profitability.
Risking only $20 a trade just to build the psychological discipline. I genuinely love that approach. But
Yeah.
let me bring up the emotional reality here.
Okay.
Because it's easy to sit and say, cut your losses. But what happens when a trader's ego gets tied to a stock? How do you actually detach when you're watching your money vanish in real time?
It is the hardest thing to do. And that deeply human instinct is exactly what causes the ultimate cardinal sin of day trading, which is averaging down.
Oh, man. Yeah. Unpack averaging down for us.
So when a stock drops against your position, the amateur thinks, well, if I buy more shares right now at this cheaper price, my average cost per share will be lower. That means the stock won't have to bounce up as high for me to break even.
It sounds so logical on the surface, like If I like the stock at $10, shouldn't I love it at $8?
In long-term investing, maybe. In day trading, Aziz is adamant. Averaging down is toxic.
It's poison.
It will destroy your account. You might get away with it 85% of the time where the stock does eventually bounce, but the 15% of the time where a stock just keeps plummeting, you now have double or triple the exposure on a losing trade.
That's terrifying.
It will wipe out months of profits in a single afternoon. So, to detach emotionally, Aziz teaches a brilliant mechanical trick. You must hide your profit and loss column on your screen while you are actively in a trade.
Wait, really? Hide the money?
Yes. You shouldn't be looking at the glowing red or green dollars. You should only be looking at the technical chart, the candlesticks, the volume, the support levels.
You're just looking at the data, not the cash.
Exactly. You have to totally decouple your self-worth from the trade's outcome. A loss isn't a personal failure, it's just a business expense.
A loss is just a business expense.
A loss is just a business expense. That completely flips the script, which gives us the takeaway line. Surviving to trade another day is infinitely more important than proving you were right about a stock's direction.
100%.
Okay, so to make sure those business expenses are actually worth it, you have to be operating in the right arena. Which brings us to our next major concept. Interesting set of 4. Hunting for stocks in play.
Because you can have the best risk management in the world, but if you pick the wrong stock, you're going nowhere.
Exactly. So you shouldn't try to day trade slow, predictable, mega cap stocks like Apple or Coca-Cola because computers and institutions heavily dominate them.
Instead, you need to hunt for stocks in play. These are specific stocks experiencing unusually high trading volume, over 500,000 shares a day, because of a fresh, fundamental catalyst, like a surprise earnings report or a major news announcement.
Something that creates chaos.
Exactly. You also want to look at the stock's float, seeking out medium float companies that have enough available shares to trade smoothly, but not so many that the price barely moves. These are the stocks acting independently of the broader market.
Yeah, that's the key.
It's kind of like, imagine you are a surfer looking to catch the best waves.
Okay.
You wouldn't drag your board into a calm, flat swimming pool. You check the weather reports to find the specific beach where a recent storm is creating massive swells.
That's a perfect analogy.
But, focusing exclusively on high-volume, catalyst-driven stocks is generally a winning strategy, but it carries a hidden risk. News can be highly deceptive.
Oh, absolutely.
A company might release an amazing earnings report, yet the stock plunges because the market had already priced in the good news.
Buy the rumor, sell the news, as they say.
Right. Additionally, finding these specific stocks before the market opens requires expensive, professional-grade scanning software.
It does, yeah.
For a novice on a tight budget, accessing the real-time data needed to consistently find these stocks in play can be a significant financial hurdle right out of the gate.
It is a financial hurdle, for sure. But let's deep dive into that concept of float and market cap, because it's so fundamental to finding those waves.
Yeah, break that down for us.
The float is simply the total number of shares of a company that are available for public trading. Now let's look at a mega cap like Apple. Apple has a float of over 15 billion shares.
That's a massive pool.
It's an ocean. It takes an astronomical amount of money, literally billions of dollars, to move Apple's price by even 50 cents in a single day.
Because there's so much supply absorbing the demand.
Exactly. But Aziz contrasts this with low-float companies. He mentions a biotech company called Thermogenesis, which at the time had a float of only 3.4 million shares.
Oh, wow, that is a tiny pool.
Right. When a massive wave of retail demand hits a stock with only 3.4 million shares available, the price can skyrocket 10, 20, even 100% in a matter of minutes.
That sounds amazing, though. Why not just trade those low floaters all day?
Because they are incredibly dangerous. Those low float stocks, anything under 20 million shares, are intoxicating. But Aziz warns they can drop just as fast as they spike.
You just get trapped.
Yeah, you can get trapped in a halt where the exchange literally pauses trading because it's too volatile, and when it reopens, your money is just gone. The sweet spot, the Goldilocks zone for retail traders, is medium float stocks, generally between 20 million and 500 million shares.
Okay, so that medium float is the sweet spot.
Yes, they have enough volatility to make you a daily profit, but enough liquidity that you can actually exit your position without getting trapped in a sudden free fall.
Okay, that makes sense. But let me ask you to clarify something on how we identify these catalysts. Let's say the whole energy sector drops today, right? Like all oil stocks drop together.
Right.
Does that make an oil stock a stock in play? What's the difference between a stock moving with its sector versus a true stock in play with an independent catalyst?
That is a vital distinction, and it's where a lot of novices get burned. No, a stock moving with its sector is not a true stock in play. Aziz calls true stocks in play alpha stocks.
Alpha stocks.
Yeah. If the broader market, like the S&P 500, is tanking, the vast majority of stocks are going to be dragged down with it by the macroeconomic algorithms. If you try to trade a quick bounce on Chevron when the entire global energy sector is bleeding red, you will get crushed by the macro trend.
Because you're fighting the current.
Right. An alpha stock, a true stock in play, has its own unique, isolated news. Because of that specific news, human retail traders flock to it, generating massive relative volume. It acts completely independently of the broader market.
Ah, I see.
If the S&P is down 2%, this alpha stock might be up 15%. The algorithms can't control it that day because the unpredictable human retail volume temporarily overpowers the algorithmic baseline. That isolated chaos is the only place you want to deploy your capital.
That makes total sense. So the takeaway line here is, you're only as good as the stock you choose to trade, so completely ignore the boring ones and focus on the day's biggest movers.
Absolutely.
But of course, to actually catch those fast movers, you can't be clicking around on a slow internet connection. Which brings us to the final critical piece of the puzzle.
Yep, son.
5 your hands, 7-5.
Yeah.
Gear up for millisecond warfare.
This is where we separate the professionals from the tourists.
Right. So to execute day trades effectively, standard online brokerage accounts simply won't cut it.
Yeah.
You must equip yourself with a direct access broker that connects you instantly to the stock exchanges.
Yep.
You also need a specialized trading platform that provides real-time market data and NASDAQ Level 2 quotes, allowing you to see the actual buy and sell orders piling up behind the scenes.
It's a game changer.
Because you are often entering and exiting trades in a matter of mere seconds, you must program hotkeys on your keyboard. Clicking a mouse through a slow confirmation screen is far too sluggish and will end up costing you serious money.
Yeah, fractions of a second matter.
It's like trying to day trade against Wall Street computers using a free basic smartphone app. It's like entering a Formula One race riding a rusty bicycle. You might be a great driver, but your equipment guarantees you will lose the race.
A rusty bicycle against an F1 car, that is exactly what it is.
But, Aziz is absolutely right. The professional-grade tools are non-negotiable for serious day traders. However, this creates a major psychological trap.
Oh, the overhead.
Yeah. Paying monthly fees for direct access brokers, real-time data feeds, and elite charting platforms adds up quickly. This high monthly overhead can create intense pressure on a new trader to force trades just to cover their software bills.
Making rent.
Exactly. This pressure to make rent often causes them to abandon their strict risk management rules and overtrade, leading to the exact impulsive, emotional decision-making that Aziz warns will destroy an account.
That is the ultimate paradox for the beginner, yeah.
Right. So tell me more about this NASDAQ Level 2 stuff and why it's so non-negotiable.
We really need to get slightly technical here to explain why it's non-negotiable, because understanding your tools is a matter of financial life and death.
Okay.
Aziz emphasizes the absolute necessity of NASDAQ Level 2 data. Now, most people who dabble in stocks, they look at charts, they look at line graphs, moving averages, maybe the RSI, but those are all lagging indicators.
Wait. Define a lagging indicator for us.
A lagging indicator is just a mathematical calculation based on what the price already did. It tells you what happened 5 minutes ago or yesterday. Level 2 data, however, is a leading indicator.
Oh.
It shows you the actual order book in real time. It shows you the bid, which is what buyers are currently willing to pay, and the ask what sellers are currently demanding. The gap between those two numbers is the bid-ask spread.
So you can actually see the future intentions of the market.
Exactly. If you were watching Level 2, you can literally see a massive institutional sell order of, say, 100,000 shares, just sitting there waiting at a specific price point. Mm-hmm. You know with near certainty that the stock is going to hit a brick wall when it reaches that price.
Wow.
You simply cannot see that invisible wall on a conventional free trading app. By the time it shows up on your line chart, you've already lost your money.
So if I'm using a zero-commission broker app on my phone and saving money on fees, am I actually just the product being sold to the high-frequency traders?
You are 100% the product. It's a vital realization for anyone listening to this. There is no free lunch on Wall Street.
Definitely not.
Those zero-commission brokers make their billions through a practice called payment for order flow, PFOF.
How does that actually work?
When you hit buy on your phone, Your free broker doesn't actually send your order directly to the Nasdaq exchange. Instead, they sell your order to a high-frequency trading firm, often called a market maker.
Okay.
That firm legally executes your trade, but they get to see your order a fraction of a millisecond before the broader market does. They skim a tiny fraction of a penny off the spread.
So they're essentially front-running us legally.
Yes. Now, for a long-term investor buying shares of an index fund to hold for 20 years, that tiny slippage doesn't matter at all.
Right.
But for a day trader jumping in and out for small, fast momentum bursts, that slippage completely destroys your profit margin. You are literally paying for the free app with significantly worse entry and exit prices. That's why Aziz insists you must use a direct access broker. You pay a small commission fee up front, but your order goes straight to the exchange. You get instantaneous execution.
Which is why the takeaway line here is, if you want to take money out of the most competitive financial arena in the world, you have to invest in professional-grade weapons.
You just have to.
But, okay, let's wrap all this up, because we've talked about the guerrilla mindset, the 2% rule, the alpha stocks, the expensive tools. How does a beginner actually put this all together without losing their life savings on day one?
You break the cycle by refusing to play with real money until you've proven you can actually win. If there is one final overriding takeaway from Aziz's text, it is the absolute non-negotiable necessity of using a trading simulator.
Like a flight simulator for pilots.
Exactly. You would never, ever expect a pilot to step into a commercial jet with 300 passengers without spending hundreds of hours in a flight simulator first.
No, never.
Yet every single day, people open a brokerage account, wire $10,000 of their savings, and start trading live on day one. It is financial suicide. Aziz demands that a trader should never touch real money without months of simulated practice.
Practice makes perfect.
Right. You need a simulator that uses real-time market data to practice your hotkeys, to practice reading the level 2 order book, and most importantly, to practice taking a simulated loss without panicking. The simulator proves if your system actually has a mathematical edge before you pay the ultimate market tuition.
If we step back and look at all these lessons, one massive, overarching theme emerges. Day trading is fundamentally an intense exercise in mastering yourself, not the market. Andrew Aziz shows us that having the best tools, the smartest stock scanners, and the most logical strategies mean absolutely nothing if you cannot control your own psychology. The market is a wild, unpredictable beast that will test your patience and discipline every single day. Your success ultimately depends on accepting losses gracefully, sticking rigidly to your business plan, and treating this profession with the supreme respect it demands. I'd love to hear if any of you have tried day trading and what your biggest psychological hurdles were, so please drop your stories in the comments below. Thank you for watching. Please like, say, share, subscribe, follow up in the next video. Let's continue. Lesson 610.
Oh, yeah, absolutely.
So to kind of kick things off here for this deep dive, I mean, we're really moving entirely past the beginner concepts of day trading today.
Right.
We're getting down into the absolute trenches. We want to decode how to read the market's underlying mood, the exact technical mechanisms that professionals use to trade. And I think most importantly, that brutal, unforgiving psychological discipline required to just, not blow up your account.
Yeah, it's huge. I mean, well, sorry, I shouldn't say huge. It's massively important. Day trading is essentially applied mass psychology just playing out in real time right in front of you.
Yeah.
But before we get into the technical weeds, I do think we have to emphasize a harsh reality right up front.
Hit me with it.
Every single chart pattern we talk about, every momentum indicator, every technical tool is completely useless without the rigid risk management and emotional control framework that surrounds them.
Right.
You can know exactly how a pattern works, but if you don't have the discipline to execute it coldly, the market will still take your money. It just will.
Yeah, that makes total sense. I mean, it's the psychology that really drives it all, which I think perfectly leads us into our first actual strategy topic. Yeah. Assuming everyone listening already knows the absolute basics, that a green candlestick means the price went up and a red one means it went down.
Right.
We need to look at what these charts are actually telling us beneath the surface.
Right.
Because you shouldn't view these as just simple price indicators. They are a real-time tracking of human emotion and exhaustion.
Yes, exactly.
The true story isn't just in the thick body of the candle. It's in those thin wicks or shadows sticking out of the top and bottom.
The tails.
Right, the tails. Those wicks show us the extreme highs and lows of the battle during that specific time period. And what we really need to be hunting for are the indecision candles, things like dojis or spinning tops.
Mm-hmm.
These are the ones with incredibly tiny bodies, but really long wicks on both sides. And that tells us that despite a massive amount of buying and selling, the price basically ended up exactly where it started. It's a total stalemate.
Yeah.
It's funny, whenever I look at a doji, I always picture this like brutal game of tug of war.
Oh, that's a good way to look at it.
Yeah, like the large, aggressive green or red candles are those moments when one team is forcefully dragging the other across the mud. You know, they're just dominating.
Yeah, they're winning big time.
But a doji, that is when both teams are pulling with maximum vein-popping effort, but the rope is just dead center because complete exhaustion is setting in on both sides.
Exactly. The momentum is just stalling out completely.
Huh.
But we do have to step outside that basic definition for a second because context is everything in trading.
Okay.
A single indecision candlestick means absolutely nothing in a vacuum. I mean, if you see a doji in the middle of a sideways, boring market, it's just noise.
Just bouncing around.
Right. A doji only matters, and it only really becomes a tradable signal if it appears at the extreme end of a long, exhausting trend.
Okay, so if I see a stock that's been surging up for, say, 4 straight 5-minute candles, and then suddenly it prints a doji at the very top,
Right.
that doesn't automatically mean a reversal is guaranteed, does it? Because I got to tell you, my instinct is to just short it right there. Just hit sell immediately.
And that instinct right there is exactly how amateur traders get crushed.
Oh, wow.
Yeah, no, it absolutely does not guarantee a reversal. It only signals a temporary pause. The market is just taking a breath. Jumping in immediately just because you saw a doji without waiting for the very next candle to confirm a change in direction is incredibly dangerous.
Wow, so it's a trap, basically.
It can be. Often the market catches its breath and just continues ripping higher.
Yeah.
And if you shorted the doji blindly, you just bought into a false signal.
Okay, that is so important. So essentially, candlesticks don't just show us the price, they show us exactly who is winning the psychological battle of the market.
Precisely. And once you train your eye to read those individual minute-by-minute psychological battles, you start to see how they string together. Those individual moments of exhaustion and continuation, they eventually build the broader structural patterns on the chart.
Which brings us perfectly to the macro view. When you zoom out from the individual candles, one of the most reliable structures that emerges is the ABCD pattern.
Oh, yeah, a classic.
Conceptually, it's a beautiful setup. So point A is a stock's strong, aggressive initial surge upward, usually right after the morning bell.
Right, everyone's piling in.
Point B represents the absolute peak of that morning run, basically the moment the buyers finally exhaust themselves.
Yeah.
But the critical moment, the place where you actually want to do business, happens at point C. This is where the stock pulls back and establishes a new higher floor as all those early buyers start taking their profits. So your goal is to enter the trade at point C, anticipating the final momentum push up to point D, which should, in theory, shatter the previous high of point B.
Exactly.
And for those trading highly volatile, low-float stocks, you'll often see the bull flag pattern, which operates on the exact same psychological principle, but it just plays out much faster.
Much faster, yeah.
I always think of the ABCD pattern like a marathon runner hitting a steep hill. That initial surge from A to B, that's the sprint. But they inevitably run out of breath. Point C is the water station. It is where they pause, catch their breath, and stabilize. If you're betting on this runner, you want to put your money down right after they've hydrated and found their footing, not when they're gasping for air at the absolute peak of the hill.
Oh, I completely agree. The problem with the peak of the hill is that it preys on the worst flaw in human nature.
Right.
Most amateurs desperately buy at point B because of sheer FOMO. You know, the fear of missing out?
Yeah, I've been there.
We all have. They see a giant green candle. They panic that they are missing the trade of the day, and they buy exactly at the moment of maximum exhaustion.
It's so painful.
It is. But we do have to be realistic about the strategy's limitation, too. Identifying a true point C in real time is actually quite difficult.
Really?
Yeah, because a pullback might be a healthy consolidation, or it might just be the beginning of a total irrecoverable collapse.
Man, I'm so glad you brought that up because I'm looking at an ABCD pattern playing out, and my instinct at point C is always just sheer panic.
Right.
The stock is dropping from its high, looks like it's dying. If my heart is pounding, how do I, as a trader, actually trust that this is just a healthy consolidation and not the floor completely falling out?
That is exactly why you cannot rely on price action alone.
Okay.
Volume analysis is absolutely necessary here to validate the pattern. When the stock drops from point B to point C, the volume of shares being traded should be noticeably drying up.
Oh, I see.
Light volume on a pullback tells you it's just early buyers quietly taking profits. If you see massive heavy volume on the way down, that's not consolidation. That is a mass exodus, and
Yeah.
you stay far, far away.
That makes so much sense. So never chase the initial surge. The safest entry is always waiting patiently for the consolidation.
Exactly. But the ADCD pattern relies on the underlying trend continuing. What happens when that marathon runner doesn't just need water, but actually collapses entirely? Sometimes the trend is completely dead and you have to flip your entire mindset to catch the turn.
Which is terrifying. But this is where we get into top and bottom reversal strategies. These are highly specific setups for when a stock's price is violently overextended.
Yes, violently is the right word.
Either skyrocketing up in this euphoric bubble or crashing down in a pure panic across consecutive candles. First, you're watching for extreme relative strength index, or RSI levels. Usually they're screaming above 80 or they've completely tanked below 20.
Oh, like showing it's way overbought or oversold.
Exactly. Once you see that rubber band stretched to its absolute limit, then you hunt for that indecision candlestick we talked about earlier.
Yeah.
A doji right near a known historical support or resistance line. But crucially, you do not enter immediately. You wait for the very next 1 minute or 5 minute candle to physically break the high or the low of that indecision candle.
Yes.
That break is the market officially confirming it has changed direction. Trying to catch a reversal without that confirmation is exactly like trying to safely grab a falling knife.
Oh, yeah.
If you try to snatch a plunging stock midair because you think it's cheap enough, you'll likely lose a finger. You have to patiently wait until that knife securely sticks into the floorboards before you confidently reach down to pick it up.
It's a great analogy, but we have to throw a massive warning flag up here.
Okay.
Reversal trading offers an incredible risk-to-reward ratio because you are getting in at the absolute turning point.
Which feels amazing when you get it right.
It does, but it completely goes against the golden rule of trading, which is the trend is your friend.
Wow.
You are actively stepping in front of a moving freight train, betting it's going to stop. Stocks can and will remain irrationally overextended far longer than a retail trader can remain solvent.
But wait, if the RSI is at 90 and the indicators are mathematically screaming that the stock is overbought, shouldn't we trust the math? Doesn't probability basically dictate it has to come down?
In a perfectly rational market, maybe.
Yeah.
But in hypervolatile, heavily shorted markets, math takes a backseat to irrational momentum.
Wow.
A stock can stay overbought for hours while it squeezes short sellers out of their positions. That is why a rigid, hard stop loss placed right at the doji's tail is completely non-negotiable.
I see.
If the stock breaks that level, the reversal has failed and you must exit instantly.
Okay, so in reversal trading, wait for the market to prove the turn has started. Never try to catch a falling knife.
Right, and to survive those reversals, you really need to know where the most logical places for the market to bounce actually are. You need to know where the true floorboards are located.
And to find those floors, we have to talk about VWAP, or the volume-weighted average price.
Oh, VWAP, the big one.
This is arguably the absolute holy grail indicator for day traders. If you have a naked chart, this is the very first thing you put on it.
Absolutely.
Unlike normal moving averages that just loosely average out the closing prices over time, VWAP actually factors in how many shares were traded at those specific prices.
Right, incorporates volume.
Which reveals exactly who is in control of the tape. If the current price is above the VWAP line, buyers are fundamentally in charge. If it is below, sellers dominate. But the real secret, I think, is why it matters so much.
Yeah, tell them about the institutions.
Institutional traders at huge hedge funds use VWAP as their literal performance benchmark. If they need to buy 2 million shares of a stock, they can't do it all at once, or the price would just explode.
Right, they ruin their own entry.
So their algorithms buy it in smaller chunks throughout the day, constantly trying to buy at or below the VWAP to ensure they are getting a fair average price. This makes the VWAP line an incredibly powerful center of gravity on a day trading chart.
It really does.
I like to picture VWAP as the surface of a massive trampoline.
Okay.
When the price of a stock pushes deeply down into it, the tension builds up. Eventually, that institutional buying pressure acts like gravity and violently snaps the price back up. It is essentially the invisible baseline of the entire market's day.
That institutional mechanic is crucial to understand. VWAP works so well largely because it is a self-fulfilling prophecy.
What do you mean by that?
Well, every massive algorithmic trading program, every hedge fund manager, and every retail day trader in the world is looking at that exact same line.
Right, everyone sees it.
Because everyone is looking at it, everyone acts on it, creating the very support or resistance they anticipated in the first place.
But does it always hold up? Like, if there is massive catastrophic breaking news about a company, do the algorithms still respect the VWAP?
Not at all. And that lost the trap.
Uh,
In highly chaotic, catalyst-driven days with breaking news, or especially in low-volume, highly manipulated penny stocks, VWAP can shatter instantly.
really just break right through.
Yes, the institutional algorithms step out of the way during extreme volatility. When that happens, traders who blindly trust VWAP as an unbreakable magical wall, they just get completely run over.
That is terrifying.
It is. VWAP isn't just a line on a chart. It is the institutional benchmark that dictates who controls the market.
And because VWAP is recalculating with every single trade, it's a moving target throughout the day. But we don't just rely on moving targets. We also have to look at the permanent architecture of the chart. So let's layer in static support and resistance lines. Unlike moving averages, these are historical horizontal price levels where major buying or selling has heavily clustered in the recent past.
The market definitely has a memory.
Exactly. We also look incredibly closely at the previous day close line. And this leads to one of the most explosive setups in trading the red to green move.
Oh, these are fun.
They are. This happens when a stock opens the morning lower than yesterday's closing price, meaning it's red on the day. But then it suddenly surges up, breaks aggressively through that previous closing price, and turns positive for green.
Yep.
That crossover point acts as massive, stubborn resistance at first. But once it is shattered, it triggers a tidal wave of momentum.
It's beautiful to watch.
Short sellers panic and cover their positions by buying, while fresh momentum buyers pile in simultaneously, creating double the buying pressure. Imagine an actual physical glass ceiling.
Okay.
The market keeps jumping up, bumping its head against it, unable to break through. But it only takes one massive high-volume leap to finally shatter the glass.
Right.
And here's the beautiful part. Once broken, that same glass ceiling you just smashed through becomes the new solid floor the market stands on.
The psychology of the red to green move is fascinating because you have two opposing forces suddenly aligned in the exact same direction, shorts buying to escape and longs buying to initiate.
Right, just creates this massive engine.
Exactly. But a word of caution about these historical lines. They look utterly flawless on historical end-of-day charts. It makes trading look so easy.
In hindsight, yeah, everything looks easy.
But in real time, you have to avoid treating them as exact mathematical tennies. A support line at $10 is not a steel wall. It is a psychological zone between maybe $9.95 and $10.05.
That zone concept is so important because I've been burned by this so many times.
Yeah.
Yeah, what about those painful fakeouts? Where the price breaks above the resistance line for exactly 10 seconds, it triggers my buy order, and then it immediately crashes back down.
That is the classic bull trap.
I hate it.
And it happens because retail traders trade purely on the historical lines without confirming the current volume. If a stock breaks a major glass ceiling, but the volume bars at the bottom of the screen are tiny, it means the big institutional money isn't actually participating.
Oh, so it's just retail pushing it over the line briefly?
Right. It's a fake breakout designed to trap eager retail buyers before the price reverses and goes lower.
Wow. Support and resistance levels are psychological battlegrounds, not exact mathematical guarantees.
Exactly. And if you think navigating those battlegrounds is difficult during the middle of the day, it is absolute carnage right when the opening bell rings.
That carnage is exactly why the opening range breakout or ORB strategy was developed.
The lifesaver for many.
Truly.
Yeah.
The first 15 minutes of the trading day are notoriously erratic. It is heavily filled with massive institutional orders processing from overnight news, combined with the pure emotional panic of amateur traders reacting to the open.
It's wild.
Trying to guess the direction in the first 5 minutes is honestly a coin flip. So the ORB strategy involves literally sitting on your hands.
Do nothing.
You do nothing. You simply watch this initial 15-minute period to see the absolute highest and lowest price the stock hits. That establishes your opening range.
Right.
Once the morning dust settles, you wait for a 5-minute candle to decisively break either above or below that established range. When it breaks, you enter the trade in the direction of that breakout, writing the newly confirmed trend for the day.
Yep.
I like to picture this like being in a saloon when a massive bar brawl breaks out.
I love this analogy.
Right? Punches are flying, chairs are breaking over heads, and absolute chaos is unfolding in every direction. Do you instantly jump into the middle of it? Of course not.
Not if you want to live.
Exactly. If you want to survive, you stand quietly in the corner. You wait for the dust to settle. You watch to clearly see which gang is actually winning, and then you calmly walk out the door they just secured.
It is an incredibly highly effective way to trade because it inherently forces patience on the trader.
Yeah, it stops you from gambling.
You are letting the market tip its hand before you commit your capital. However, the ORB is heavily dependent on the stock's market cap and liquidity.
Oh, interesting.
Yeah, it works beautifully for mid to large cap stocks, companies with predictable thick liquidity where trends actually follow through.
So can I run a 15-minute ORB on some highly volatile $2 penny stock that's just spiking in the news today?
I explicitly warn against this.
Really?
If you try an ORB on a low-float penny stock, it will aggressively whipsaw you. These stocks are too thin and they are too easily manipulated. They will intentionally fake a breakout above the morning range just to trigger the entry orders of retail traders and then instantly reverse plummeting to stop you out before going back up again. The ORB requires a stock with enough volume to sustain a real institutional trend.
That is so good to know. So patience at the market open allows you to let the amateurs fight it out while you wait to trade the actual trend.
Exactly. Let them get beat up in the brawl.
But here is the ultimate truth. Whether you are trading an ORB and ABCD setup or catching a reversal off the VWAP, none of these technical patterns will make you a single dime if you don't know exactly what to do the millisecond you click the buy button. We really have to detail the absolute necessity of a rigid step-by-step trading plan. Day trading is not about reacting, it's about executing a pre-written script.
100%.
Before the market even opens, a professional day trader must vet a small, highly curated watch list. You aren't just looking at random tickers flashing on CNBC.
No, you can't just chase scanners all day.
Exactly. For every single potential trade on that list, you must establish an if-then scenario. This means defining the exact entry price, the specific predetermined profit targets where you will sell half or all of your position, and most importantly, the unmovable hard stop loss price.
The emergency brake.
Yes. Once you enter the trade, your analytical brain basically turns off, and your only job is to execute the blueprint. You do not reevaluate the company's fundamentals, you do not hope, and you absolutely never change your stop loss mid-trade.
Never.
Think of it like building a house. You don't start pouring the wet concrete foundation and then casually decide where the plumbing should go on the fly.
That would be a disaster.
Right. You draw the blueprint in the quiet, calm environment of your office. Then when you step onto the noisy, chaotic construction site, you strictly follow the lines you already drew.
It sounds so logical when you explain it like that.
It does, doesn't it?
But while the theory of a trading plan is remarkably simple, human emotion makes the actual execution incredibly rare.
It's so hard to do in the moment.
When a trader is in a position and the stock unexpectedly dips, ego instantly takes over.
Oh, yeah.
The trader refuses to accept that their analysis was wrong. They refuse to accept a loss.
I've been in this exact spot.
Tell me about it.
What if the stock dips and it's approaching my stop loss, but I look at the level 2 data and it looks like it's going to bounce just right below my line? Can I just give it a little more room to breathe? Just this once. I aggressively reject this mindset.
Wow, okay.
This is the exact moment careers are destroyed. The moment you move your stop loss based on a gut feeling or hope or wanting to give it more room, you are no longer a trader. You are a gambler sitting at a slot machine.
Ouch.
A stop loss is not a suggestion. It is the emergency brake on your account.
That hits hard, but it's true. Plan the trade in the calm of the pre-market and trade the plan in the chaos of the open. This exact discipline, the ability to take a small planned loss without ego, is quite literally what separates the 90% of traders who fail from the tiny fraction who actually survive and thrive. And we actually have a perfect real-world case study to illustrate how this transition happens.
Right. Let's look at the case study of John Teavone, a trader outlined in the book who finally achieved consistency. And he didn't do it by discovering some secret magic moving average indicator.
They never do.
He did it through extreme, almost painful discipline. John's breakthrough happened when he restricted himself to trading just one single strategy. In his case, the break of high of day.
Okay, just one setup.
Just one. By focusing on just one setup, he filtered out the overwhelming noise of the rest of the market. But more importantly, he used strict hard stops and deliberately risked a tiny identical amount of money, just $20 per trade for months.
Wow.
He fully accepted taking small, highly manageable losses while he perfected his mechanical execution. He only allowed himself to increase his risk size once he proved to himself that he could be consistently profitable over a long, measurable period.
That takes so much restraint.
It does. It's identical to medical school.
Yeah.
A surgeon doesn't walk in and perform a complex triple bypass on a real human being on their very first day.
God, I hope not.
Right? They practice on computer simulators. They practice tying stitches on banana peels for months until the muscle memory and mechanics are absolutely flawless. Only when the process is perfected do they step into the high-stakes operating room.
There's a harsh cultural reality we have to address here, though.
What's that?
Society, and particularly social media, heavily sells day trading as a glamorous, get-rich-quick scheme. You see the guys with the Lamborghinis.
Oh, all the time on Instagram.
Right. So telling an undercapitalized beginner who just wants to quit their horrible job that they're only allowed to risk $20 a trade for 6 straight months, it's deeply frustrating for them. It feels like they aren't making any real progress.
So is the biggest enemy for retail traders just a lack of capital then? Like if they had 100 grand, they wouldn't have to start by risking $20.
No, that is a massive misconception. The biggest enemy is a lack of patience.
Really?
Yes. If you give a bad trader 100 grand, they will just lose it faster. Undercapitalized traders usually scale up their position sizes way too fast out of pure desperation to replace their 9-to-5 income.
Oh.
They force trades that aren't there, they ignore their risk management, and the impatience inevitably destroys their entire account.
That's a tough pill to swallow. So consistency and survival must always precede the pursuit of profit in day trading.
Absolutely. You can't win if you get knocked out of the game in week 1.
All right, well, let's bring all this together. We've covered a tremendous amount of ground today, but the core truth remains the same, whether you are identifying a doji at the top of a massive run, mapping out an ABCD consolidation pattern, waiting patiently for an ORB, or plotting a bounce off the institutional VWAP line. Absolutely none of the technical analysis matters if you don't treat trading as a serious, highly disciplined business.
That's the bottom line.
Success in this arena isn't about being the smartest person in the room with the fastest internet connection. It is about being the most disciplined. It's about being ruthlessly process-oriented rather than result-oriented and managing your risk on every single click of the mouse.
Very well said.
Remember, the market isn't just a math problem to be solved. It's a giant mirror reflecting human fear and greed right back at you. Which side of the mirror are you going to be on?
Hopefully the discipline side.
Exactly. If you enjoyed this deep dive, please like, share, and subscribe to the show. Also drop a comment below sharing your own experiences. Have you struggled with setting hard stop losses or battled the FOMO of buying at the top of the morning open? We'd love to hear how you handle the psychological pressure. Thank you for watching, everyone. I hope you found this content helpful. Please stay tuned for the next episode. Goodbye.